You look at the stock market right now, and man, on the surface, things look fantastic. The market's soaring, everyone keeps talking about a soft landing, the party is in full swing. But do you ever get that feeling that something's just a little bit off? Like you're in a beautiful house, but you hear this strange scratching noise coming from inside the walls? Well, today, we're going to go find out what that noise is. Okay, so let's dive right in. What you're seeing here is the public stock market, the party everyone's invited to. This is the story we all see on the news every single night. But what's so fascinating is that while this is all happening out in the open, a totally different and much, much darker story is unfolding underneath it all. It's happening in the hidden plumbing of our financial system. And it's a story all about debt, deception, and yeah, a whole lot of danger. So that's really the central mystery we're going to try and solve today. If everything's so great, what's that weird smell coming from the kitchen? And to figure it out, we're going to use this really powerful idea from the world of finance. It's got a pretty memorable name too, the Cockroach Theory. Now, I know what you're thinking. Cockroaches. But just stay with me here, because the theory is actually pretty simple. When you flip on the kitchen light late at night and see one cockroach scurry away, your first thought isn't, oh look, a single lonely cockroach. Nope. Your first thought is, oh man, how many more of them are hiding in the walls? Well, in finance, it's the exact same thing. A single shocking company collapse is almost never just that one company's problem. It's usually the first sign of a much bigger, much deeper infestation hiding from view.
And wouldn't you know it, we just saw two cockroaches scurry out into the open. The first is a company called First Brands Group. You've probably used their stuff without even realizing it. They make things like Fram oil filters, Trico wiper blades. The second is Tricolor Holdings, a big lender for used cars. Both of these companies look totally solid from the outside, and then they just suddenly imploded in a pretty spectacular way. So today, we're going to go on a little financial detective journey. We're going to treat these two companies as our first big clues to figure out what they tell us about the rest of the house. So here's our game plan. We've got the theory down. Next, we're going to dig into our first clue. These cracks that are starting to form in a massive, kind of hidden part of the financial system called private credit. Then we'll see how this stuff is actually affecting businesses on your main street. After that, we'll look at a really surprising connection to the AI boom. And then finally, we'll connect all the clues and see the big picture and deliver our final verdict. All right, let's get to it.
All right, time to start the investigation. Clue number 1 takes us into the world of private credit. Now that sounds super complicated, I know, but you can really just think of it as this giant, multi-trillion-dollar shadow banking system. It's basically where all the risky stuff that regular banks don't really want to touch anymore has gone to hide. So what even is private credit? Well, in a nutshell, it's this giant $1.7 trillion pool of money where big investment funds lend directly to companies, completely bypassing the normal banking system. And here's the crucial part. It happens with way fewer rules and almost no public visibility. Think of it like a massive party with no chaperones. It is the absolute perfect place for huge risks to hide, right up until they cause a massive mess. And let's look at exactly how that works by digging into our first cockroach, First Brands. Okay, this is where it gets absolutely wild. First Brands was basically playing this super sophisticated shell game to make itself look healthy. So they were getting cash early from their customers and then paying their own bills late. Seems like a nice trick, right? But here's the real trick. Imagine you own a house, and you use that one single house to get a loan from Bank A. And then, without telling them, you go to Bank B and get a second loan on that exact same house. That's pretty much what First Brands was doing with its money. They were borrowing against the same dollar twice, creating billions in cash that wasn't even real. It was a house of cards just waiting for a breeze. And when that house of cards finally came tumbling down, wow, the scale of the collapse was just breathtaking. The company left a hole, a liability hole, estimated to be somewhere between $10 and $50 billion. I mean, this wasn't some small accounting error. This was a catastrophic failure hidden by complex financial tricks that supposedly very sophisticated investors completely missed. So, how'd they miss it? This right here, this shows you why this is a system-wide problem, not just one company. What you're looking at are two different investment firms, and they're both looking at the exact same loan to First Brands, right before it went belly up. One firm valued it at over 101 cents on the dollar, basically saying, this loan is perfect. It's even safer than lending money to the US government. But the other firm saw a ticking time bomb. So how on earth can the same exact thing have two totally different prices? Well, it's because in these private markets, you get to do something called mark to model, which is just a fancy way of saying you get to grade your own homework. And that lets problems stay hidden right up until the day they explode. Okay, let's switch gears to our second cockroach, Tricolor, the used car lender. Their fraud was a lot simpler to understand, but just as devastating. So normally, when you get a car loan, the bank lends you money, and they hold the title to your one car as collateral. Pretty simple. What Tricolor was allegedly doing was taking the title for one car and using it to get loans from Bank A, Bank B, and Bank C all at the same time. It's basically the financial version of selling the deed to your house to 3 different people. So when the company collapsed, all these banks suddenly realized their secure collateral was worth a tiny fraction of what they thought. Okay, so we've seen fraud and some crazy financial engineering in the shadow banking world. But our second clue shows this isn't just happening in some obscure corner of finance. Nope, it's happening on Main Street, probably to businesses you visit all the time, like your local veterinarian or your dentist. See, for the last decade or so, private equity firms have been running this simple playbook called the roll-up. They go out and buy up hundreds of small local businesses. I'm talking vet clinics, dental practices, even HVAC repair shops. Then they roll them up into one giant company, load that new company up with as much cheap debt as they possibly can, and then try to sell the whole thing for a massive profit. The entire strategy was built on one single critical assumption, that money would always be cheap. And now, that assumption has been completely shattered. With interest rates way higher, that mountain of debt is suddenly becoming totally unaffordable. The interest payments are so high now that they're eating up all the cash, starving these businesses of the money they actually need to operate. So what were once healthy local businesses are now being turned into what they call zombie companies. Technically still alive, but just crushed under the weight of all that debt piled on by their new owners. All right, now for our third clue. And this one comes from a place you might not expect at all. The exciting, booming world of artificial intelligence. I mean, everyone is talking about the AI gold rush, and it really looks like a revolution. But let's pull back the curtain for a second and look at how this gold rush is actually being financed. You might start to see some familiar patterns. And this just perfectly illustrates what's going on. There's this kind of financial money go-round that's powering the AI boom. Let's just trace the money for a second. An AI cloud company like CoreWeave goes and borrows billions of dollars. Step 2, it immediately turns around and spends all of that borrowed cash on chips from Nvidia. That makes Nvidia's revenue look amazing, right? Then, and here's the kicker, Nvidia takes some of its huge profits and invests it right back into CoreWeave. That helps CoreWeave's valuation go up, which then allows it to, you guessed it, borrow even more money to buy more chips. It's a circular loop where debt is creating revenue, which is then used to justify even more debt. Now, if this whole thing sounds a little familiar to you, it really should. We have seen this movie before. This is just eerily similar to the dot-com bubble in the late 90s. Back then, telecom companies borrowed billions to lay fiber optic cables, all financed by companies like Cisco. But when it turned out they had built way too much fiber, the value of that collateral, the cable itself, collapsed almost overnight. The big risk today is that these AI chips, which are being used as collateral for billions in loans, could see their value evaporate just as quickly. And hey, it's not just startups. Even a tech giant like Oracle is kind of our canary in the coal mine here. They've committed to spending an absolutely astronomical $50 billion on AI infrastructure. But even with all that investment and hype, the company just reported negative $10 billion in free cash flow. That means cash is just burning out the door way faster than it's coming in. This is a classic textbook sign of a bubble, spending insane amounts of money today in the hope of some uncertain profits way down the road. Okay, let's hit pause on the investigation for a second and just look at the clues we've gathered. We found some really shady stuff happening in private credit, we saw a business model on Main Street that's completely falling apart, and we found this really fragile debt loop that's fueling the entire AI boom. So now, let's connect all these dots and see what the full picture actually looks like. And you know, this brings us to the most important question of all. This stuff can feel really abstract, really distant. But who actually gets hurt when all of these hidden, risky loans start to go bad? Is this just a problem for a bunch of hedge funds on Wall Street? Well, the answer, unfortunately, is a big fat no. The problem is that the stress from these hidden corners of finance is starting to spill over into the traditional banking system we all use, especially regional banks. And these aren't the giant Wall Street firms. These are the banks in your town that give out loans to local small businesses. And a lot of these banks are dangerously overexposed to the exact same things that are in trouble right now, particularly commercial real estate, which is in the middle of its own slow-motion crisis. And you can already see the stress showing up in the real economy. This isn't theoretical anymore. I mean, existing home sales are basically frozen at levels we have not seen since 1995. The number of people falling behind on their rent in big apartment buildings has quadrupled, and delinquencies on subprime auto loans, the same market Tricolor was in, have now blown past the levels we saw in the 2008 financial crisis. And all of this is happening before this huge wave of commercial loans, over $1.5 trillion worth, has to be refinanced at today's much higher interest rates. It's a potential tipping point, for sure.
And let's just bring it right back to our first cockroach. The bankruptcy of First Brands isn't just some line item on a spreadsheet for an investor. It has real-world consequences. It could mean that retailers like AutoZone or Advanced Auto Parts might literally struggle to keep basic car parts like oil filters and wiper blades on their shelves. The failure of one hidden company can ripple right through the supply chain and end up affecting you directly.
So, after following all these clues, what's our verdict? What if we actually learned from this whole investigation? Well, it really seems like the market is trying to tell two completely different stories at the exact same time. On one side, you have the stock market story. And it's a happy story, right? It's a story of a soft landing, incredible AI-fueled growth, a healthy consumer. In this story, any problems are small, they're contained. But on the other side, you have the credit market story, the market for debt. And it is telling a much, much scarier story of a hard landing, an AI bubble built on fragile debt, a deeply strained consumer, and a systemic infestation. You can think of the stock market as the fancy wallpaper in the house. It looks great. But the credit market, that's the plumbing. And right now, the plumbing is flashing some really bright red warning lights. So just to recap our whole investigation here, from fraudulent loans hiding in the shadows, to a failing business model right on Main Street, to that fragile debt loop fueling the AI boom, we've seen how stress from all these hidden corners of the economy is now spilling out into the open, threatening the banks and businesses we all depend on. So what's the takeaway here? Is it time to panic? No, absolutely not. The goal of this was not to scare you. It's to make you aware. It's to give you a different lens to look at the financial world with, so you can see beyond the happy headlines and understand the full picture, the good, the bad, and, yeah, the things that are hiding in the walls. So we've seen a few cockroaches scurry out into the light, and they've revealed a whole lot about the state of the building. So the question this leaves us with isn't if there are more out there, but where else are they hiding, and what's going to happen when someone finally turns on the lights in the rest of the house?